Alright, so here are all my positions in my Questrade account. So first of all, most of my trades are covered call trades, and then I've got some Iron Condors and then very little dividend stocks. So first of all, in my margin account, I've got an American Airlines covered call trade. So this is a stock I bought at 31.36, 100 shares, and I immediately sold a call option at a 31 strike price expiring June 21st, and I collected $1.21 for it. So that's about a return of, if I divide 121 divided by 31.36, so it's about 3.8%, expiring June 21st. Now I don't remember when exactly I placed this trade, but we can go look under executions, and then past 3 months I can look up AAL. So the one I bought at this is 31.88, this is 30.85. Let's go back and check. So this one was bought at 31.36. So this, they took the average. So Questrade shows the average of both prices. So it's either the one I bought at, it's probably the one I bought at 30.85 because I sold a 31 covered call. So it's actually bought at 30.85 and I collected $1.21 and I chose a strike price of 31. So it's actually higher than 3.8%. So it's actually 30.85 minus $1.21. And then if my shares get sold at 31, if by June 21st the stock is trading above 31, then my shares will get sold at 31, and that'll be a difference of $1.36. So I'd collect $1.36 divided by a 31 sale price, let's say. So that's 4.3% return in, so this was May 20th that I placed, so it's about exactly 1 month. So a 4.3% in 1 month with this covered call trade if American Airlines does trade above 31 come expiry date. Now this was trading actually at 27 or 26 last week when everything was dropping. So if it does stay below 31, what's going to happen is I'm going to end up keeping my shares of American Airlines. I keep my premiums, of course, that I collected of $1.21, and I can sell another call option at a 31 strike price. And if we want, we can go see what that gives us. So I'll click on create order, and then I'll just remove the shares just to see what I would get if I were to sell another call option next month on American Airlines, let's say expiring July 19, or let's go 30 days out. So we're June 7th, so let's go July 5th, let's say, at the same strike price of 31, I'd be able to collect $1.22. So about the same thing, or exactly the same thing. So now my other American Airlines trade, so this one I guess I bought at, this would be the one I bought at 31.88. The reason it's showing 31.36 is because Questrade takes the average when they present it under the positions tab. So this one was at, I forgot already, 31.88, and I sold a call option at a 32 strike price, collecting $1.20 again. So in this case, my return is going to be around the same thing, about 4% as well. If, of course, American Airlines is trading above 32 come expiry date, then my shares will get sold at 32. If not, if it's a below 32 come expiry date, then I'll just keep the shares and I get to sell another call option. But instead of selling at a 31 strike price like the first example, I'll have to sell at a 32 strike price since my cost was 31.88. But if they both expire at the same time and I keep both positions, so if I keep all 200 shares, because let's say American Airlines is trading below 31 come expiry date, so I'm going to end up keeping both shares. So then I could choose a different strike price. I could choose a combined strike price of, let's say, 31.5, since my combined cost is 31.36. So then let's see what I would get is if there is a 31.5. Yeah, so there's a 31.5. I'd be collecting about 90 cents, 93 cents right now. 30 days out, be collecting 93 cents at a 31.5 strike price. So that's about a return of 95 divided by 31.5, let's say. So that's about 3%. So not bad for 1 month return or 30 days. Then I've got Activision. So this is a stock I bought at 43.81. And I sold a call option immediately at a 43.5 strike price, collecting $2.12. So that's about, let's calculate here. So 2.12 divided by 43 point, actually we should remove the difference. So it's actually 43.81 minus 2.12 and then minus my strike price of 43.5. So it's $1.81. $1.81 divided by 43.5. So it's about 4% as well. So another 4% in 30 days. And by the looks of it, if the market doesn't crash again like it did in the past few weeks, looks like my shares will get taken away at 43.5 because it's already trading at 45.38. Now, if I look at Bristol-Myers, this is a call option that I sold for about 60 days because Bristol-Myers had dropped. I bought it at 50 and it's trading right now at 46.75. I only collected 36 cents last 2 months, but hopefully this upcoming month I'll be able to collect a little bit higher. We'll see. Actually, let's go see right now. So my cost is 50, so I don't want to choose a strike price below 50. So I'm always going to want a strike price at 50. So if I remove the shares here and then add another call, sell, let's say I go for July 19. But then see 47 strike price, I have to change it to 50 because my cost is 50. I don't want to sell my shares below that, of course. So if I choose a 50 strike price, it's only 30 cents. So yeah, that's pretty weak. So hopefully by June 21st, this stock goes up a little bit. Even if it goes up to 48, it should be fine. So obviously 30 cents divided by 50 is nothing. 30 divided by 5,000 is not even a 1/6%, but this is in 30 days. So let's say times 12 months, it's about 7%. So it's not bad yearly, but I know I could do better with covered calls. So not all my covered calls are going to be decent returns. So this American Airlines, Activision were pretty good, but Bristol-Myers is bad. Box now, for example, I bought at 19.98. It dropped after earnings to 17.4. But I had already sold a call option at a 20 strike price expiring June 21st, collected $1.38. So this is a return of about 7%. And actually, let's go see in how much time. So Box I bought on May 10th and went all the way out to June 21st. So a bit more than a month. So a month and 10 days. So 7% in a month and in 1 month and 10 days. So it's not a bad return, of course. But now that Box dropped all the way down to 17.41, if I were to sell another call option, because obviously I'm going to end up keeping my shares because the market price of 17.4 is below the strike price of 20. So I'm going to end up keeping my shares. If I'm going to sell another call option, so I'm going to add another call here. I've got 2 contracts because I've got 200 shares. So let's say I were to sell the July 19. And of course, I got to pick a strike price that's not lower than my cost because I don't want to sell my shares lower than what I bought it at. So I got to stick to the 20 strike price, and that would get me about 17 cents right now. If the stock stays at 17.4, maybe by June 21st it'll be higher. So what does that give me? So 17 divided by 20 or 2,000 is about 0.85% times 12. That's 10%. So yeah, so right now Box is not doing well for me because it dropped hard. But the first month I collected 7. If we average it out, that's not a bad return monthly. My goal is to make between 2 and 4% per month. So now I've got JD.com, a stock that I bought at 27.18. Right now it's trading at 26.8. I sold a call option though at 26. So the reason I went for a strike price that's lower than the price I paid for it is because I felt like I was buying it a little bit too high, and I felt like the stock is going to drop, and I was collecting enough premiums to actually compensate for taking a lower strike price. So even with the strike price lower than the cost, the premium compensates for that and more. And the more that I was getting gave me a decent return, I think of 4%. So right now, this is actually the second time I sell a call on JD.com. So if we look up the stock, so yeah, you can see here I bought it at 20. Well, this is in March. So in May I bought it at 27.18, collected $2.38. at a 26 strike price. So we have to remove the difference first. So 27.8 minus 26. So we have to remove $1.18 from $2.38. So that's, I'm left with $1.20 divided by 26. That's 4.6%. From May 7 to, I think it was expiring June 7th. There you go. It was expiring this week, June 7th. But I actually bought it back early to sell another one. So then I bought back the option at 51 cents to sell one at $1.51. So the difference here is 115 minus 51, so $64. So I collected another $64 divided by 2,600. So that's 2.4%. So I went and collected another 2.4% between last week and June 28th. So about another 30 days. So first month I collected 4%, and then second month collected 2.4%. Actually, the first month is not even a full 30 days because I actually closed it early. I've got Kraft Heinz, which was pretty much a useless purchase. I don't know why I bought it. I bought it when it dropped hard from 50 to 30, 35. So I bought it 30. My average cost was 36.05. Right now it's trading at 28.74. But I keep collecting a few cents every month. So last month I collected 20 cents. So that's about a return of 0.5% in 1 month. So that's pretty bad. But it's like you could consider it a dividend. Plus Kraft Heinz pays dividends. So I'm getting the dividends plus a little extra. Maybe doubling my dividends. If I'm getting 0.05%, if I'm getting 0.5% per month times 12, that's 6% per year. So it's like doubling my dividends on Kraft Heinz and a little bit more. So Macy's is a stock that I bought a while back. I bought at 25.8, but I sold options on it several times. Here we could look here under executions. See, this is only showing me 3 months back. So yeah, last month in May I was able to sell it for 92 cents, but when the stock dropped to 21, I'm unable to find a decent call option, because obviously I want to stick to my 26 strike price. I could probably sell a call option at 22, but then I have the risk that if Macy's for some reason goes past 22 by expiry date, then I'm stuck selling my shares at 22, so I'm making a $3 loss per share. So I have to pick a 26 strike price, because even if there's no earnings coming up or no special events, anything can make a stock move or either up or down. Some analyst downgrades or an analyst upgrades, and you don't really expect, you don't know when these news are coming out. So I'd rather stay safe and pick a strike price that's close to my cost. So if we look at Macy's, let's see what I can get off Macy's. If I go, let's say to July 19, see, at a 24 strike price, I collect 5 cents. So that of course is not gonna be enough even after commission. So I need to go further. Let's say I go to August 16 now, that's 2 months out. At a 24 strike price, I get 23 cents, but I don't want 24, I want a 26 strike price, because my cost is 25.8. So at 26, I'd collect something in between 8 and 15. So after commissions, not worth it, especially if I'm going all the way out to August. So either I have to pick a strike price that's closer to 20, or go even further. Let's go to November 15. 26, I'd collect 32, 33 cents. So I guess I could do that, but obviously I'm disappointed because I'm going all the way out to November, collecting a very small return. Or I could just wait a little bit. Hopefully the stock goes back up a bit, and then I can sell a call option at a 26 strike price in 1 month period instead of going 4 months out. All right, if we go back to my positions, I've got Mattel. So I bought it at 11.65. This is the second time I sell a call option on it. So let's see what I sold the first time. So I bought it at 11.65 and I sold a call option for 65 cents at an 11.5 strike price. So it's basically 50 cents. 50 cents divided by 11.5. That's what I made for the first month, which gives us a return of 4.3%, which expired May 31st. But then I sold another one expiring July 5th, but this time only collecting 15 cents because the stock dropped hard. It went, I think, to even $9 or $8, but then it creeped back up. So that's good. So hopefully it stays above this price and continues, and either my shares will get sold at 11.5, or if it stays below 11.5 by July 5th, well, I'm gonna just end up keeping the shares, and I could sell a much better call option for the following month. So even if the stock dropped, I was still able to collect 15 cents, which gives me a return of 1.3%. So first month was about 4%, I said. Yeah, 4.3%. Second month is about 1.3%. So still a very good return. I've got Micron here that I bought at an average price of 38, but I actually bought it higher. I bought it twice. So, but definitely, as you can see here from the call option, that I sold at 35. So I most likely bought it at around 35. And actually, let's look it up under executions. So yeah, so I bought it at 34.87, and I sold a call option at a 35 strike, collecting $1.87. So that gives me a return of, if I take the 34.87 minus $1.87, and then that gives me 33. And then if I were to sell, if my shares were to get sold at 35, then I would collect $2. $2 divided by 33, that's about 6%. 6% in 1 month with this trade here, if Micron is above 35 come June 21st. But before that, I actually bought Micron at 41.53, and I sold a call option at a 41.5 strike price, collecting $2. So that gives me exactly 2 divided by 41.5. That gives me 4.8% in 1 month. It actually expired last Friday or today, but now this time, if I were to sell another call option, I would have to pick a strike price of 41.5. Of course, I'm not going to get anything decent. So what I'm going to have to do is wait for this one to expire, and then I could consider selling a call option at a 38 strike price. And hopefully Micron goes up by then, which it should, because obviously it just went down because the general market went down. But let's look what we can get if I were to pick a 41.5 strike price. So let's say we go July 19, 41, there's no 41.5. So let's change the date. Let's go July 26. There is no 41.5 either. Let's go July 12. For sure I'm not going to find anything decent either. All right, it's so the cost is so far I can't even find a decent strike price. But I guess let's take 42 then on July 19 just to be safe. So 42, I would collect 27 cents. So not so good, but still better than nothing, right? So 27 divided by 41.50 is 0.6%. Actually, if it does end up above 42 come July 19, I'm going to get an extra 50 cents because I bought the stock at 41.5. But I'm sure by either if I wait for June 21st, and so I can combine both shares, both positions, I'm sure Micron will be trading closer to 41 by then, and then the premiums will be higher. So I've got Six Flags as well that I bought a while back. This is probably the third or fourth time I sell a call option for it. So this one was 40 cents on a 54 strike price, but a 55 strike. So if Six Flags does end up above 55 come June 21st, I'd collect an extra $1 per share. But for now, I'm only collecting the premium. So 40 cents divided by my cost of 5,400 is 0.7% per month. And then I've got an Iron Condor trade on the SPX, so the SP 500 index. So initially I had a range of about, I think, 2760 on the put side and 3,000 on the call side. So giving me a very wide range. But of course, last week or the week before, the S&P 500 dropped below 2760. So there's different ways to adjust an Iron Condor. But the way I prefer right now to adjust is to actually close the losing trade and just place a new trade, changing the strike prices. So placing a new trade, changing the strike prices, but keeping the same expiry date. So the expiry date on this initial Iron Condor was June 21st. I placed it about 45 days ago. So now there's 2 weeks left to June 21st. So there's 2 weeks left to the expiry date, but the S&P 500 right now is trading at, it went back up. It's trading at around 28.77. So there's a chance that it hits my call side, of course. So that puts me in a bad position. As you can see, my put was updated. My put side was updated. It went from 27.60 to 27.05. So I was giving myself more room, but now it looks like I'm gonna have to update it again because the S&P 500 is trading at around 28.77. So it's getting very close to my call side, which is 2890. So what I'm gonna have to do is buy this trade back to close it at a debit. So it's probably gonna cost me, here we could see how much it's gonna cost me. It's gonna cost me something in between 155 and 335. So probably around 250. It's gonna cost me around $250 to close this trade. But I'll go ahead, immediately sell another Iron Condor, expiring June 21st, so same expiry date, but I'll have new strike prices. So I could probably have a strike price of, let's say, on the call side, 29.25, and on the put side, I could probably have something like around 28.25, for example, to get close. So I'm adjusting my strikes. So I'm changing my put strikes and I'm changing my call strikes to get closer, to compensate for the fact that the S&P 500 is probably going to break 28.90 next week. So we'll see what happens next week, and I'll take care of it next week. I also have another Iron Condor on the SPY. So this is basically an ETF that follows the S&P 500 index. This is the actual index. This is just an ETF that follows it, but it's much easier to trade. There's a lot of volume, a lot of different strikes, a lot of different expiry dates as well. So it's easier to trade. And so this one expires July 5th. I picked a range of 267 to 293. So I did this obviously when the S&P 500 was trading in the low to 2700. So I picked a 267 strike on the put side and a 293 strike on the call side. But now, of course, it looks like it's going to be close as well. It's the SPY closed at 288, so it's getting close to my 293 strike. So it looks like I'm going to have to adjust this one as well. But because there's still a lot of time left, I'll wait a bit. I mean, I still have like 3 weeks left or more. So I can wait a little bit on this one, but it definitely looks like I'm going to have to adjust at least the put side. I can bring it closer because now it's really far. I can bring it closer for a credit, and then I'm going to have to move out the call side for a debit. So for example, I could just close this whole trade for $1.40, let's say, something in between these two prices here, and then I'll place another trade, let's say between 280 and 295. Hopefully that new trade will compensate for the fact that I had to pay $1.40 to close this, but I already collected 93 cents when I initially placed this trade. So my overall is 93 minus $1.40 plus, let's say, $1.35. So now I'm down to $88. So I lost a little bit. I reduced my profit, but just to protect myself from a bigger loss. So I'm okay with that. And let's just see what I would get if I were to update my strikes, let's say to 2,800 or 280, let's say. I think I'm gonna have to get closer to get a decent credit, but let's just see what I get. 280 and then 5 points wide, so 275, and then this one here would have to be 295, let's say, and then 300. So I'd collect a higher credit here because I'm getting very close. So I'm making the range smaller. So this would actually be a credit adjustment. So the adjustment would actually increase my profit instead of reducing it. So I'd actually so I started off with 93. I'm going to buy it back for $1.40, but I'd collect about $1.68. So I'd be in a profit position of $1.21 if, of course, the SPY ends stays between 280 and 295 come July 5th. If it doesn't, I'll have to make other adjustments, and then who knows how much the other adjustments will cost me. But that's the plan with this Iron Condor trade. And then I've got Teva Pharmaceuticals here, covered call trade that had an option expired, but of course it dropped hard. So now for me to sell a call option at a 15 strike price, I'm gonna have to go further out, which is not something I want to do, but I might have to if I want to extract something from it. So, but I'm just waiting to see, give it a chance. Maybe it might come back up again. Got Western Digital. It's similar to Micron. It dropped hard, but I know it's going to come back up. So first, I bought it twice as well. So so now it's showing the average price. But I think the first time I bought it at 50, and the second time I bought it at 45. But I collected some decent call premiums for it. If you look in executions, look at WDC. So yeah, so first month sold it for $3.40, and then when I bought it again the second time, I collected $2.27. And then when this one here, the $3.40 expired, I sold some more at $27. So as you can see, there's a big difference between what I sold the first month and what I sold the second month. But that's because the stock went from 50.9 to, I believe it was trading at around 43, or actually it was trading below 40, but I still made $27, so it's still some profit, but definitely a big difference between 340 and 27. But that's why I just need the stock to come back up, or to get close to 40 to 41. But even if sorry, I said 41, but I meant 50. But now my average is 47, so if it just gets close to 47, I'm okay. Weight Watchers has been rough for me. I bought it at 30. As you can see right now, it's trading at 19. I've been selling call options every month, but I'm at a 25 strike. So I'm actually taking a risk here, picking a strike that's lower than my cost, but I'm very confident that, it's not going to jump from 18 or 19. It's not going to jump from 19 to 25 in 30 days. So I've got 2 weeks. As long as Weight Watcher stays below 25, then I've got nothing to worry about. And I've got United States Steel as well, that hasn't been so great. Collected about 7 cents, but 7 times 4, so that's about $28. And bought the stock at an average. I bought it 4 times at an average price of $18.29, and it's trading right now at 13.5. So hopefully next month it gets closer to 18, and I'm able to sell them I'm able to collect a better call premium. Actually, let's see what I can get right now if I were to sell 30 days out. So let's remove the shares, add a call, sell, add 4 contracts, and let's say we go to July 19, and of course we have to pick a strike price of 18 because that's what my cost is. So I'd collect 5 cents. 5 times 4 is 20, so $20 this time. So pretty low. So let's just hope it goes up like everything else. So these are all my positions in my margin account with Questrade. So as you can see, they're mostly covered call trades and some Iron Condors. So if you have any questions, leave them in the comment section below. And as always, if you're going to open an account with Questrade, use my referral code in the description below the video to get up to $250 back. Thanks for watching.